Welcome back to part 2 of the video series that I've been talking about. The last video we did on triggers in the United States, and now we're looking at particular triggers in the European Union. Now, I believe that Europe is going to collapse. It's probably going to bring the whole house of cards down. It's either that or China. I think America is in a bit of a stronger position than either of those two blocks at the moment, and you'll see why as this video and the next video. Now, with Europe, what we have is that I think we need to look at a bit of context. Back in 2008, we had a credit event, which was the failure of two American financial institutions, Lehman Brothers and Bear Stearns, that started the whole liquidity crisis off. Now, it was both a credit crisis and a liquidity crisis. And it's one of those things that if you have a credit crisis, you have the banks in particular don't really know the credit strength and the credit worthiness of their other counterparty, and hence the reticence to do any transactions with that counterparty. And that had an ongoing effect of taking liquidity completely out of the market for people that needed the liquidity, and hence the actual credit crunch. Now, as much as I don't think that the Fed has done a good job since the crisis, I must admit that I remember when the crisis happened and thinking, wow, this is pretty close to financial Armageddon, because the whole system was seizing up. And I remember the vivid pictures of ships in port in Singapore, Hong Kong, all the exports, because they couldn't basically write letters of credit to transact, to get their goods on and off from the ships. So it was a very serious situation to be in as far as global trade's concerned in banking and the finance. So it was a welcome relief that the Fed came in as a lender of last resort and pumped the system with literally trillions of dollars, but it was necessary. But the mistake the Fed has made is it continued to do so because of the fragility in the banking sector, and this was further highlighted in 2011 when the dominoes started to fall in Europe as well. So what we're faced with in Europe, and I believe, as I said, Europe is in a credit crisis at the moment. It just hasn't become as obvious as it has been to many people in the mainstream media, etc. But it is there, and I'm going to explain how and why and how these triggers are going to get set off in the very near future potentially. So it's very extremely important why I bring up Lehman's and Bear Stearns, because they were financial institutions and they were linked in the system, as it were. So if we're in the situation in Europe, as I believe, that some of the banks and the financial institutions there are in a very, very poor position, then why not the same situation happen again? Because again, counterparty risk will come up, and then we'll have collateral calls on outstanding derivative contracts. There's a whole gamut of potential dominoes falling as we go forward. Now, what I'm going to do is I'm going to look at the ECB supervision division, some figures from that, which are actually quite frightening. Now, one of the aspects and triggers that I think that's going to set the whole train wreck, or stop the whole thing in its tracks, is non-performing loans. Now, it might surprise you that the EU in 2016 had close to €1 trillion in non-performing loans, and just the recent estimation is where it's more of a defined figure. We're talking about the European Supervision Division estimates that we've got 880 billion, which is, think about it, that's nearly €1 trillion of non-performing loans. That's bad loans. That's loans that have got a likelihood of never being repaid. So this number, which is big in itself, is likely to grow once the economies of Europe tip into recession, especially in Germany. And we're starting to look at a recession globally. The figures are starting to turn down, so it's not an unrealistic assumption within the next year or so of us being in a full-blown recession. Now, whether or not it's a really bad recession depends on the health in the European banking sector. So what's going to happen is the European banks, their solvency will be a major problem going forward, and we have multiple banks in multiple EU countries that have really poor performing loans in their portfolios. Now, if according to PIMCO, their research, we have approximately 200 billion of Italian loans that are bad in their banks. You might say, well, that's 200 billion. What's this 880 billion? That's like 680 billion other non-performing loans. That to me is a very worrying factor, because everybody's worried about Italy, but yet, according to the Eurozone supervisory division, there's another 680 billion out there. Where? You've got to ask yourself the question, where is this 680 billion? Now, let's cycle back a bit, again back to the 2008 crisis and the resources that are needed to finance and liquefy a market once it goes into a liquidity problem, a credit spiral. In 2008, in the UK, the market capitalisation of RBS, Royal Bank of Scotland, was 66 billion, and Royal Bank and Barclays, Lloyd's, was 34 billion. When you add those figures up, 100 billion. Well, guess how much it actually took to get confidence back into the UK banking sector? We're talking about those two banks, and some of the other banks like Barclays were looking a bit delicate as well. It took close to $850 billion. Pounds. We're talking about close to 1.2 trillion dollars at the time to liquefy the British market, to ensure there wasn't a credit crunch with banks with a market capitalisation of 100 billion. That's a factor of 10 to 1. And how was that made up? So 76 billion was to purchase shares in RBS. Remember, their balance sheet, their market capitalisation was 66 billion, so the government puts in 76 billion. 200 billion went in to liquefy the wholesale borrowing by banks. A further 40 billion went in to provide loans and other funding to Bradford and Bingley, which was a building society. It's like rather the savings and loans organisations in the United States. The building societies are generally financial intermediaries that provide loans for mortgages, and are not into the commercial mortgage market, but just purely loans to householders. So 40 billion went to them. 280 billion went in principle to provide insurance for a selection of bank assets. And then we start going into 67 billion for total government spending in the financial year 2009-2010. So there was a lot of liquefying that the Bank of England had to do. So as I said, the point was for 100 billion, 1.2 trillion. Now wait a minute, I've just alluded to the fact we've got 680 billion of non-performing loans. That's non-performing loans. That's not other baddies in the cupboard waiting to be exposed, and we haven't even talked again about sovereign bonds. So just the non-performing loans is a nightmare situation potentially ready to happen, and of course a lot of banks are exposed to this. Another part of the article in PIMCO basically stipulated that much of this debt, especially the Italian debt of 200 billion approximately, is with 5 banks. So we've got 5 banks sitting out there with close to 40 billion worth of bad debts on their books. And so that is quite a frightening aspect. So what are those banks also exposed to? Because the Italians have 387 billion of their own sovereign bonds. They're holding 387 of their own sovereign bonds, and we're going to allude to this a little bit later in the video, because the outstanding government debt of Italy is close to 2 trillion. So there's something there that I want to allude to later, which is actually quite frightening as well. So what we're looking at is an EU banking crisis of quite extraordinary size of things. Now, why do I feel that the banks aren't going to be necessarily able to counter this? Is because back in 2014 there was a stress test of 130 banks, of which 9 banks failed. And what is not a surprise is that quite a few of the banks that did fail were Italian banks. And how they failed was in their common equity tier 1 side of things. They didn't have enough provisions. set aside on their balance sheets that were of good quality, liquid assets. And this is still a problem that's rolled forward because, as I've said before, the banks are gaming the system in terms of their balance sheets. And I'm going to go into more detail on what this entails for the banks in terms of their exposure to sovereign bonds as well, not just the net non-performing loans. So what we have is that we have got multiple banks, especially Italian banks, that failed the stress test, which are a joke in terms of the fundamentals that they look at. One of the reasons, going back to the common equity tier 1, is because that common equity is gamed, and it's gamed because if you think about it, not if you think about it, under the Basel III and the Bank of International Settlements guidelines, sovereign bonds have got 0 risk weighting. Now, what are you going to do as a bank if you're shoring up your balance sheet? You're going to put as much 0 weighted assets in there as possible. So what this has meant is that the banks have been disencouraged to lend to the commercial sector, because just say, for example, for $1 million you've got a corporate ABC widgets, and they go to the bank for a loan, and the bank says no because you're too risky. And the reason behind this is because, just say for example, they've got a risk-weighted asset on that of 0.6. What the banks basically have to do is they've only got a 600,000 euro asset weighting on their balance sheet for that. Whereas, why not go for an Italian government bond with 1 million that has a 0%? So there's no encouragement to lend out to companies, and therefore companies in the European Union are being bank starved. And this has got major ramifications later on, as I say, because of zombie companies and the creation of zombie capital, for want of a better term, instead of working capital and profit. So we have multiple banks that are potentially exposed to non-performing loans, a banking system that is shoring up its balance sheets with 0 risk assets that are actually loaded with risk, and we have a European commercial sector that's being starved of funds because the banks are funding their own balance sheets because they've got so much non-performing loans and other bad loans and other exposures that they probably don't want to talk about at the moment. So what we have is we've got multiple banks that are weak. We've also got banks in certain countries that are really in poor condition as well, and again, this is probably where a lot of the 680 billion is hiding. I mean, just in France, we've got SocGen and BNP Paribas. We have Banco PBM, Ubi Banca, and Banca Carige in Italy. We've got Deutsche Bank, the daddy of all banks, that's in very poor condition in Germany, and if that one goes, that's it. Game over. The European Union and the euro crashes. It'll bring everything else down with it. Lehman's is going to be a little boy in the corner, basically, compared to this big man going down. And then, very interestingly, in the last stress test in 2018, 2 UK banks came up again. And this was only out of a sample of 44 banks. 2 UK banks, Barclays and Lloyds, failed on the stress test. So not only do we have the same suspects of Spanish banks out of a much smaller sample than the 130. We have 2 British banks that still aren't out of the woods yet, and this is 8 years since the crisis in 2011. No, I think just in this part of the European banking sector, as far as non-performing loans are concerned, there is a major crisis coming, and yeah, I don't think we can avoid that. And looking at that I think it would be negligent not to point out that these things are all potential triggers in the crisis to come.